So thank you, everybody. I am Mark Peterson. I am with SFRhub Advisors. We are a nationwide brokerage focused solely on portfolios of rental homes. I want to thank all the viewers and attendees for signing in today, and I definitely want to thank all the panelists for agreeing to do this. I am going to let everybody, all the panelists, introduce themselves, and then Don Walker will be giving a bit of an overview of PowerPoint, and then we'll jump right into the discussion. So Randall, how about if you start off?
All right. Hey, everyone. Thank you for joining us today. My name is Randall Henderson. I'm with Property Management Inc. Franchising Group. We have 340 locations managing around 80,000 properties, primarily single family and multifamily. Just excited to be here and talk about all things property management related. So thanks for having me.
It's a special person who gets excited about all things property management. So awesome.
Very true.
John, if you could introduce yourself.
Thanks very much, Mark. John Watt from Unitas Financial. One of our core specialties is working with real estate investors, whether that's fix and flips, buy and holds, rental properties, build to rent, note buyers, anything else. We've got 28 years experience working with all different types of investors, and we'd love to either be a resource for you for information, or if we can provide our products and services, we'd love to do that. Thanks so much for the invite to the panel. I think you're going to get some great information today.
I think so. Thank you, John. Dalton, if you don't mind going next.
Sure. Thanks, Mark. Hey, everybody. I'm Dalton Elliott, Director of Sales and Customer Experience at LIMA One Capital. We are a nationwide lender to real estate investors, everything from rehabs and rentals to new construction and multifamily projects. And we also just launched a fun podcast today, The Real Estate of Things. So give that a listen. Glad to be here.
Great. Thank you. Mike, if you don't mind introducing yourself.
Sure. Mike Owsley. I've got about 40 or more years in the valuation side of the business and doing both residential and income producing properties. I am with ProTech Valuation Intelligence. We're a nationwide firm that provides anything from automated valuations to full appraisal type valuations on property, and we do a lot of data mining and data reporting and such on different markets around the country. I'm glad to be here.
Great, thank you. Don, I saved you for last, so you can roll right into your presentation afterwards.
Thanks, Mark. And thanks to SVN for having me here. I'm excited to be on the panel. I'm the managing principal and CFO of John Burns Real Estate Consulting. We have two sides to our business: research, where we produce reports every month for all things housing, and we have a specific report that covers the single family rental and built rent space. And then the other side of the business where I spend most of my time is in consulting, where we're helping builders, developers, and investors with their strategies on what to build, and then obviously with feasibility studies. So again, thanks, Mark, for having me. And I am going to attempt to share my screen. Keep your fingers crossed. Thumbs up, Mark, if you can see that.
I can see that.
How about that?
Sometimes technology works just the way it's planned.
Sometimes, right? Okay, well, Mark asked me to share with everyone our outlook for key economic and housing market stats in about 10 minutes. So we're going to move really quickly. We're going to have an economic overview. We're going to talk about the for sale housing market, the single family rental and build for rent market, and then wrap up with the apartment market. And I am going to go fast, so if you want the slides, you can send me an email, and the last slide will have my email address on it. So first, in a very big picture, we believe we are in that portion of the economic cycle where there is high risk and high reward. And that continues to play out in the housing market. And so we are forecasting continued increases in sales volume, as well as home price and rent appreciation. But on the risk side, there is a more cautious note to pay attention to. We've got rising debt levels. That's at consumer, company, and for countries, and asset values, worsening affordability to buy or rent a home, and rising housing supply. These are all things that we need to keep an eye on. But we think housing is safe from any oversupply in the near term, but we think there is a risk for oversupply moving into 2024, 2025, and I'll talk about that a little later. We do expect the economy to continue to expand into 2021 as the vaccine rollout accelerates. As of September, the good news is 63% of Americans have received at least one dose, 54% are fully vaccinated, and at the current pace, we think 70% of the population over 12 will be vaccinated by November. So that's good news and helps to continue to open up the other parts of our economy. So what does that mean for employment growth? As everyone knows, we had a record drop in job losses in 2020 because of the pandemic, but we've come back fairly strong. This year, job growth will grow by 3.1%, or about 4.4 million. We think that's going to improve moving into 2022 by 6.2 million, and then slow back down to 2 million, and then about 1 million in 2024. And part of that slowdown in future job growth is related to an aging demographic. So we're going to have more people reach retirement age than people replacing them entering the job market. So actually, we do need migration, frankly, to help the economy keep going. So moving into the housing market, the first thing I want to cover is our outlook for U.S. single family and multifamily permits. As you can see, we've continued to grow off the coming out of the last Great Recession. This year, we think we'll hit around 1.7 million, but in 2022 and 2023, we think we'll hit around 1.9 million or so permits and starts. Now, what's important about that is we are forecasting demand of about 1.4 million homes a year. And so very quickly here, we think we're going to get into a much more balanced housing market than we've experienced over the past 18 months. And I just talked about the rise in permits. So single family starts have also risen. They've gone up 26% in the last year. And this is just single family, does not include multifamily. So we, as of July, on a year-over-year basis, we hit about 1.1 million starts, or a 26% increase. But, and this is the amazing part, is that completions have only risen 5%. And it's resulted in a huge bottleneck of unfinished housing. And that's largely, when we talked earlier before the panel started, there's been a lot of material shortage and labor shortages. And so why does it matter? Because right now, everyone is benefiting from strong rent or price appreciation because of lack of supply, but that supply is coming. And that's one reason why we think home prices are, the rate of growth is going to slow down materially in 2022. So this slide is our home value index. This is what we think is going to happen with home values for existing homes around the country. This is the national average. So in 2020, values went up 11%. Currently, they're up about 20%, and we think those numbers are going to slow down to around 3 to 4% and basically go flat in 2024. For new homes, similar story. And actually the story that we've been hearing from our for sale builder clients around the country is that they couldn't keep up with construction. Sales couldn't keep up with the construction. So they've been metering sales or raising prices dramatically to slow things down. Well, that's worked. It's worked so well that in some markets, some builders have started to put out incentives again to regain their sales momentum. So we think new home prices will go up 16% this year. Again, that 2 to 4% range in 22, 23, and then pause a little bit in 2024 as that supply starts to exceed demand. And so we do show this around the country. We have a rating system where a typical market or normal market's around 2 to 3 new home sales per month per project. And so what we have is there are no markets that we currently rate as very slow, but a couple, Chicago, Minneapolis, are relatively slow. And then we have some markets that are normal. San Francisco, Houston, Fort Lauderdale, DC, and Cleveland. But look at how many markets are rated as strong or very strong. So I'll take a quick pause there so everyone can take a look at the markets that they're most interested in. But the bottom line is 88% of the markets we cover are rated as strong or very strong. All right. Now I'm going to move into the single family rental and build for rent markets. So the first thing I want to share is the occupancy trends. This is for the broader single family rental homes. These are the plus or minus 60 million homes that are scattered around the country. And we have hit the highest occupancy level in close to 25 years. We're at 95.1%. Now, I do want to point out the single family rental REITs and the large institutional single family owners are doing better than that. The REITs are reporting a 98% occupancy level. They've achieved a 14.3% rent hike on new leases, and they've hit a record low annualized turnover at only 27%. So the market is doing very well. It's, in fact, we can say it's firing on all cylinders. And again, that's a beneficiary of the housing surge, demand surge we've had, and the inability to quickly add supply to the market. So here's a look at the history and our forecast for what we think is going to happen with new leases for single family rental homes. Again, these are the broader market, not the REITs. So we're looking for about a 7.4% increase in 2021 and between 3 and 5% through 2024. And that's going to be going down, and we think because of basically reduced affordability and a little less government stimulus to keep things going. So this is a history of the cumulative rents that have gone up in some of the top markets since 2011. And we do cover 63 of the markets. These are the top 20 or so. On average, those 63 markets have gone up a total of 45% over that time period. So again, I'll pause here so the audience can take a look at the markets that they're most interested in to see how they compare. All right, and jumping over to occupancy levels. So I already talked about how occupancy levels at the highest rate it's been in 25 years. And again, this is the broader single family rental market, not the REITs. But you can see some markets that are experiencing tremendous demand. Denver, Las Vegas, Austin, in the high 90s. The average here for these 20 markets is 93%. And then some markets like a Phoenix, a Raleigh, or Orlando, which are second home or vacation home markets, those naturally have a little bit higher vacancy factors, so no need to be concerned there. They're all doing very well. And this is a forecast of our single family rent growth, cumulative single family rent growth through 2024. And so again, I'll give a pause here so you can look at the markets you're interested in. But basically, those markets that are experiencing high job growth or high immigration are doing very well, and we expect to see some pretty strong rent growth over the next few years there. The one thing I would say is be cautious about, we also look at rent to income ratios, and we're at near an all-time high in many of the top 20 markets. So just be careful about trying to raise or assume rents can go up too much before we'll start to see the market push back a little bit. All right, and BFR. BFR is booming now. That's demand from tenants as well as investors. We have over 550 active build-to-rent communities in our database. BFR operators are actively buying land. They're representing about 10% of the market. And our consulting team has conducted about 300 or 350 market studies over the past 18 months. And this is where those projects are located, and we have it by product type. And again, it's small, so send me an email and I'll send you the stats here. All right, but in our database, the build for rent communities that are stabilized are almost 98% leased, and the typical absorption is around 12 a month. And obviously that varies by strategy. And last but not least, I'm going to quickly run through the apartment slides. We do expect apartment rents to grow. We think it'll hit about 6% this year, and then again between 3 and 5% over the next few years. And following the pullback that we saw in 2020, we see that every major market experienced strong apartment leasing this summer. Not surprising, one of the largest markets, Dallas, absorbed 8,000 units in the last 3 months. But bottom line here is apartment market is coming back, but we do need to watch out for supply. There's still markets there which have a very heavy pipeline. And if there's any bit of a slowdown in job growth or migration to those markets, some of the gains we have seen in rent growth will probably get tempered. So just pause there for a second so everybody can see their markets. And that is my last slide. So again, if anybody wants these slides, just shoot me a note at my email at dwalker@realestateconsulting.com. And that's it, Mark. I will stop sharing and move it back to you.
Thank you, Don. And anyone viewing who wants it can, if you didn't get Don's email, reach out to us. We can connect you and send it out also. And I also want to mention that if any of the viewers have any questions, feel free to submit them. We will gather all those up and have the panelists address them, and then we will send out kind of an electronic document or e-booklet or something like that after the webinar. And I think one of the things, I have a couple questions. I'm going to put you on the spot a little bit here as a follow-up, but I remember in, let's say, the second half of March of 19, how many builders we spoke to in sheer panic from their entire lot production, land holdings, spec houses, everything, and they wanted to liquidate it all. Other than the fact that the market has done almost the exact opposite of what everyone expected, what would you say are some of the big takeaways and surprises from the last, let's say, 18 months, whatever it's been?
Well, this is going to sound obvious, but in hindsight, nobody would have expected how rapidly our government, actually governments around the world, responded to the pandemic. I forget the number, but it's north of $5 trillion that the U.S. government has put out to stabilize the market through enhanced unemployment benefits and other vehicles. And that has really helped spur the market. It's driven down interest rates. People basically realized how important their home was and are looking to either improve it. So we've seen, the Lowe's and Home Depots of the world benefit from that. And people looking that can work remotely, moved out of the city, the core city areas where it's a little bit more affordable, where they can get a little bit bigger house. And that has really spurred demand from both home ownership as well as rentership. So I guess the big surprise was just how effective, and I'm sure there are things that went wrong along the way, but just how effective the rescue packages have been for the economy and people's homes.
Yeah, I remember some of, so for those of you who don't know, if you're a client, John Burns Real Estate Consulting does monthly webinars, which is the unbelievable amount of data that they can talk through in an hour. And I remember some of John's early on where he had graphed out the amount of stimulus that was already hitting the economy and some that was projected to come in, is staggering amounts, especially for those of us who watched the real estate market completely collapse, especially those of us in Phoenix, Vegas, Miami during the Great Recession. So that was our backdrop for a lot of us, which luckily didn't happen.
Yeah, fortunately, right? Exactly.
Yeah. So Audrey, I'm going to jump over to you, kind of picking up on some of the changes of housing and locations, and then we'll broaden this out to everybody, of the last 18 months, even from, let's say, the underwriting and, let's say, the optimized house, to the extent someone could actually work with a builder to design a house these days, a whole community. How has some of that changed over the last 18 months, year kind of thing?
Yeah, I will jump into that quickly. I'm going to quickly introduce myself as well. I'm Audrey Carlson. I work with SVN SFRhub Advisors. I've led the underwriting of about 70,000 build for rent homes to date, either through consulting engagements, our national brokerage focused fully on portfolios of build for rent or existing asset SFR portfolios, and our capital management platform. So definitely to jump into that question, we saw a lot of changes, and I think some of those will be interesting to see when you're looking at product type and unit mix and bed count and square footage of rental homes versus retail. It'll be interesting to see what trends kind of end up sticking from going through COVID and going through the different moving of residents to different states and such, and the work from home. But we're definitely pushing towards wanting a little more of that extra space. So that's also one of the draws from apartment units to build for rent homes, is being able to pull up to your own home, your own unit. Even so, even though you're renting, it still feels like you own your own home, you have your own space. So we always, rental homes versus retail product is always typically smaller. So we're looking at usually sub 2,000 square feet, 3 and 4 bed most popular. We are seeing, and it's definitely dependent per market, but we are seeing the larger floor plans be a little bit more popular in some markets, some Texas markets, the Carolinas, looking at Tennessee markets as well. Some of those floor plans with the 4-bedroom instead of the 3-bedroom end up being more in demand, because those extra bedrooms can be used as offices for either parents or kids, working from home for school. So there's definitely a little bit of a shift. It'll be interesting to see what is lasting and how much working from home is lasting, but it's definitely market dependent as well.
Yeah, we're definitely seeing changes, and when Audrey does the underwriting, it's a lot of data based. And Randall, I think from you, you're actually on the front lines. Your group is with interacting with the residents, as opposed to we're interacting with data and a high level. What are you seeing some of, if it's by market or across the board, of what residents or potential residents are actually asking for when they can?
I think that's a great question. And Don, I love that you touched on the vacancy rates. This is definitely an abnormal recession, but when you look at the renter profile, it actually breaks down a little bit more detail. There seems to be a bigger divide in the haves and the have-nots, even in terms of the renter profile. So if you look at vacancy rates for income earners above $75,000, which, by the way, is a very much now a renter profile, the vacancy rates are much not quite as low as those that are making less than 40,000. So what we're seeing is that a lot of new starts and a lot of multifamily builds are focused on that newer renter profile, who want more amenities, and they want better management. They want credit reporting and all kinds of other things built in, hence the need for a good property manager. But on the flip side, there could be a problem in the future on that housing supply for that lower income. And for example, in the Harvard University report, which comes out annually, they talked about just kind of where is the housing for the lower income earners? And we're seeing maybe an attraction in tertiary markets toward that type of property, or maybe even moving outside of the bigger cities into suburban neighborhoods to address that need. But I thought that Don's slide was very appropriate. We're just definitely seeing that not every renter is equal in today's world. And you have to, as a property management company, look for better, more services that you're providing. I hope that kind of addresses what you were touching on, Mark.
Yeah, it definitely does. And I think a lot of that, if we kind of boil some of this discussion down to best practices for current investors, for potential investors who are looking at either build for rent, scattered home, existing assets, or even multifamily, that there's a whole lot that definitely, I would say, over the last 18 months, much greater changes than 18 months prior to that on where people are looking, what they're looking for, and that type of thing.
And not just that, Mark, but the investor profile has changed quite a bit over the last few years. And as that's gotten more and more mainstream, I think that property management generally has been kind of the redheaded stepchild of the industry in many ways. But we can't live in the shadows anymore, right? I mean, that's like there's significant pressure. That's why we're all on this call as far as what that investor is looking for nowadays. And so specifically in the property management world, you need a manager who's going to add significant value, be able to provide all the amenities. That's been the rise of PMI for us. And one of the secrets of why we've been able to take over and consolidate a lot of these small mom and pops across the country. They're just not able to keep up on what today's investor wants and needs. Whether it doesn't matter on the class, or I think everybody's expecting a new form of consulting from their property manager or from their asset manager in a way that hasn't been there before. So that's why we need the best tools, we need the systems, and we need better partnerships, frankly, with a lot on this call. If you're an investor out there and you're looking, you need to build a team like you see that touches all these different areas that you'll see on this call to help evaluate, and property management's a big part of that. So that would be my.
Mark, if I could just add to
Sure.
that, I think it's so important, especially when it comes to build for rent housing, location and product are clearly important. Pricing it right is clearly important, but the property management of it is, I think that's, the secret sauce to having a successful rental community. So people want to stay there and you can renew them and have less turnover, et cetera. So Randall, that was so important. I just had to say that. So I'll turn it back to you, Mark. Sorry.
Yeah, no, that's great. Yeah, we've seen the rise of, let's say, the third-party institutional quality property management has definitely facilitated the rise of acquiring, especially the scattered lot, but kind of portfolio. But even on a whole community of build for rent, a property manager, and then John, let's jump over to you, based on this with insurance. But, if one piece of that is missing, or someone underwrites the wrong percentage, or they're factoring in, an average tenancy of 14 months because they're used to multifamily versus, unless you guys have updated your data, Don, 5.5 years on average for a built for rent home. Those are fundamental cost differences and efficiencies between those. And what we see, John, and now I'm going to jump over to you, is the two real variables on a portfolio, and let's just stick with any one of the asset classes in underwriting, are really taxes and insurance. Insurance, as us panelists were talking beforehand, is a complete wild card almost right now, accurately predicting those. Insurance should not be a complete wild card in underwriting. And as Randall said, and Don reiterated, the notion of a team to help you, you, the investor, through this and to get that set up is, do you sleep at night or do you not sleep at night? And do you own this long-term versus short-term? So John, if we're looking at best practices, let's say for underwriting from insurance, what are some of the kind of the components people should worry about? Is there a meaningful difference between say townhomes, whole communities that detached, scattered lot, anything like that?
I don't think there's a huge rate differential, and there isn't any one class that's, let's say, in crisis there right now. And my overview on the insurance part, it's a necessary expense, just like taxes. You're going to have some of it, unless you're, in a cash position and you want to take a lot of risk. The outside factors that are all combining to, make the rates move up are the construction costs. So that means we have to value properties higher than what we did in the past. The cost of building materials to repair something in the event of a loss. And now what do you do on it? Well, okay, we can either make adjustments in coverage, meaning that taking things like taking a higher deductible can give you some premium relief. And as long as you don't have a lot of claims, you're going to realize some pretty significant premium savings there. Then on the operational side, Randall's favorite subject, and that would be best practices. And what that means is that, when there's a snowfall, we get the snow shoveled up, that we don't have any loose railings on things. Educate your tenants as well. With COVID, we've got more people staying home for a longer period of time. So that means we've seen an increase in things like kitchen fires, put something on the stove and then go take a nap or something like that. And then we've seen a lot more litigation as well. But I think that has to do with folks spending more time at home. So there's a bigger incidence of them, let's say we have a loose step somewhere, or we have a raised sidewalk. Well, with more traffic on there, there's going to be more incidents of somebody falling down. So that said, best practices management, keeping it the way they want it. And it also helps to maintain the value of those properties when we keep them up. Everybody loves to live in a nice place. And when everything's just the way that it should be, they'll try and keep it nice as well. But if it starts to deteriorate, then we see just a complete collapse. Sorry, that was a lot of information there, probably, Mark, but hopefully that can sort of give the why and what we can do about it. And, that reach out early in your buying process, find out what the insurance numbers are so that they aren't a big fat wild card for you. And then you can plug in the right number on something that you can depend on.
Yeah,
right?
I think that's a key notion of reaching out early to your, if someone's invested to their team, whether it's to John for insurance, to Mike for valuations, to Dalton for financing, to Randall for property management. All the variables can kind of come into themselves and become knowns. Mike, the last, as we've talked, the last 12, 18 months, house prices have gone ridiculous and in just about every market. So it's not even historically where I can sell out of my house in Phoenix and move to Chattanooga and have a value arbitrage of any, of a meaningful amount there. Valuation and appraisals in a market like this, at least in our experience and perspective, is quite a challenge, keeping up with pricing in this market, and then certain markets outperforming others and types of markets and asset classes.
Was there a question in there?
Oh, well, just, what are some of the ways that so let's say Dalton comes to you with a portfolio and is looking for some valuation services of, all right, last month this was worth $5 million. This month it's under contract for 7.5, and it still seems to make sense. Is whether it's a for sale or for rent, even an investment, I think with some of the rents and what's happening is a very important discussion for a lot of the investors and underwriting.
Yeah, I think the biggest challenge from a valuation standpoint is just trying to keep up. Oftentimes valuation is a backward looking kind of thing. So you're always looking at what happened in the last month, 2 months, 3 months to try and figure out where we are today. I think where we've been over the last 18 months or so is where are we going to be tomorrow and what's driving this? Real life instances are where people are, moving up to larger homes potentially, or buying second homes where they, are finding that they can work from other places. I've also seen an awful lot of indication of people renting homes in nice locations where they say, I don't need to live in San Francisco where it feels confining and all that. I could actually live in the Colorado mountains, and still do my work. And so I'll go and rent a home there for a period of time. One of the things I and kind of off the topic, but I had a question for John actually around costs, because one of the things that's impacting a lot of folks around the West in particular, but I think we're also seeing this along the Eastern, Southeast and such, are all these disasters that we're seeing and the loss factors that are going in there. And I live up in a high fire area, and the insurance companies are just canceling insurance. And it's not like I'm living in the forest. I mean, we're talking about large areas where they just are, the insurance companies are saying, well, we'll insure you, but it's going to be something like 5 to 10 times what you were going to pay before. And so I was wondering how, John, you guys are looking at that, in some of these areas that's happening. I mean, even the state sponsored types of fire insurance programs are very expensive, while you can get coverage, and then the deductibles are very large as well. So, I'm just wondering, how that plays out.
Well, I think that, we're seeing an increase in natural disasters, whether it's windstorm, tornado, hail, the fire, the whole thing. So we've got to deal with it. You can debate the cause all day long, but the fact of the matter is we've got to deal with it. Typically, the thing that is going to help on the rate and the availability is to work with a little bit higher deductible type program. So we're not dealing with losses that are $1,000 or something like that. And then I think that also there are sometimes things you mentioned, the fire exposure. A lot of times, at least if we're in an area that's way outside of town, there'll be a brush fire endorsement or something like that, which means that you need to keep, brush X number of feet from your building. Well, sometimes that can really help out, and especially if you offer that information ahead of time. When you're repairing or building your homes, having them up to code or in excess of code sometimes can qualify for discounts that can really drop that windstorm exposure. Portfolio houses in Oklahoma, pretty much for the insurance carriers, is totally undesirable. But if we've got a group of houses that have brand new roofing to a higher code than what the typical one is, then it's a whole different equation. Does any of that make any sense? Does that help?
Yeah, absolutely.
Can I jump in here as well? Because one product that you got that may not be on your horizon or on your radar right now that we've started offering is a resident liability insurance package that is required to live with PMI in a PMI home. It's basically just $100,000 policy that the tenant pays for that covers specific catastrophic type of damage that a tenant can do: flood, fire, just things like that, explosion. And it's a very inexpensive policy. We just make it required. If they can show that they already have that on their normal renter's policy, which almost none do, we'll waive it. But without fail, we don't get pushback on that. And that's just another layer of protection that maybe is not on your radar.
Well, that's a good point, Randall. And then you're transferring a little bit of the liability through to the tenant, so that if something silly happens, like they leave the water on the sink and fall asleep, and now you have three apartments that are flooded below it, or in multifamily, it could be a lot more than that. It also allows you to take a higher deductible on your master policy, which will allow you to save a lot of money. Good point there.
And Mark, back to,
go on.
I'm sorry, I was just going to kind of circle back on the valuation piece because I kind of got off on a little bit of a tangent, but I think one of the things that for Randall, for instance, is, kind of having an understanding of where the values are going, and kind of that, for your investors, what's their position. There's a lot of tools out there that are available for both indexing things forward and getting a good snapshot. There's automated tools even where you can run whole portfolios and try to find out kind of a price point of where things are going. And I think the importance there is not doing it twice a year, it's doing it monthly, so you can capture those incremental changes, because they do change. I mean, as we know, in a recession, property values, I think one of Don's slides talked about the depreciation of values and how much equity was lost, in 2009, for instance. And so having that idea of what things are doing on a real-time basis, on a consistent basis, measuring that so you can see these incremental things. Maybe things aren't going up at 20% all of a sudden in a particular market, and it's starting to level off. That's the time to really start paying attention. It could go either way. We don't know. Were there job losses in the area? Are people moving out of those areas to more affordable areas? Those kinds of things that would ultimately impact the price stability of the real estate that you own.
Yeah, and I think that's a perfect segue into a discussion with you, Dalton, of, when we talk to a number of investors, the fact that financing is actually available, either for, portfolio level SFR or especially built for rent, if they aren't in this every day, it almost surprises them. And with LIMA One has been a pioneer for years on the rental home financing. What are some of the things some investors, since financing is a topic every investor is at least interested in, since we know very few who like to pay cash and run cash through time?
Yeah, you touched on one of the big pieces, build to rent. Right. And you and I were catching up a little bit before this call started on land development. So, a big chunk of my time at LIMA One Capital has been to build up our wholesale sales channel, working with mortgage brokers, right? Took that from 0 to over 300 million a year. And one of the more frequent, completely unfulfillable requests I would get, my team would get, was land acquisition and development money, that A&D. So we are specialists at LIMA One on the vertical piece, right? If you have land that's good to go, fully platted, utilities, everything like that is in, foundation up, we have aggressive financing, good to go. But up until that point, we don't have that horizontal specialty, right? You're looking to buy attractive land, develop that land so it can be ready for that vertical financing. And so we sought out, we wanted to fix that problem, huge problem in the market, really a unicorn. So we linked up with Setanta, which is a land A&D group based out of North Carolina. The name comes from an Irish warrior, so it's one of the more genuinely cool and interesting company names I've ever heard of. But John Curry is their CEO, and long story short, a couple of weeks ago, we formally launched a relationship to where, the solution for us wasn't adding on a completely new division to deal with something that's quite different from our day-to-day SFR, multifamily and portfolio lending. It was to link up with a group that could provide that horizontal piece. So that is really that pioneering and problem solving that you were getting at, is the ability to find spots in the market that are just completely underserved. So that's one big piece that for years and years, we just had very few relationships or outlets for that. Definitely a higher caliber of investor, right? It's not a first timer who's going out and doing land A&D.
I hope not.
More sophisticated sponsors, but that's on the building side. And then, when capital markets and everything turned on, call it summer of last year, got comfortable, everybody got back out lending, the table is completely flipped, right? Going into COVID, us and plenty of other folks in the space were heaviest on the rehab lending, right? 1 to 4 unit rehab lending. Coming out of kind of that COVID capital market freeze, the tables had completely turned. and rentals skyrocketed, now make up a massive part of the business. Of course, interest rates are always a high topic of consideration. You asked what are investors talking about, asking. That theme has remained completely constant. That's always a conversation.
That in recourse or non-recourse?
Bingo. Yep. Recourse, non-recourse, and especially, the more sophisticated the investor, the more conversation there is around the guarantee piece. Definitely flexible options here, and a common sense approach. I think, from the genesis of our company to this day, one of the key differentiators, and it's tough to, stack up against competition empirically. Don, you being a numbers guy, just plug your ears, but I feel like we rate at the top of the mark on that common sense piece of just taking a stock of kind of the investor's profile and experience. That's really, for us, what we have seen to be the biggest driver for what we are going to do. How far out on the ledge are we going to go for investors? And certainly not a completely unique approach, but credit, cash on hand, those things are great and definitely a huge part of the underwriting process. But experience has proven to be, time and time again through the billions of dollars we have originated, the single biggest factor on, is this loan going to pay off, or is this going to be a problem? I would take a sponsor with high experience and a couple dings on credit or cash over perfect credit, perfect cash. I was watching HGTV last night, and I'm gonna get after it with my first deal today. So kind of bounced around a lot there, but that's
You mean even fix and flips aren't as easy as TV makes it? I come in, I fix it up, let alone, I hope a whole community development from acquisition of raw land through entitlements is most definitely not someone's first foray into investment. That is that is a unique animal all by itself. And we've known John Curry for years, and their depth of knowledge on A&D, build for rent, for sale, and connection into the builder community is very impressive. So that's when I talked to John last week about it, that's a great, like you said, a missing piece, but it wasn't just missing for LIMA 1, it was almost effectively missing for the entire industry. And, a typical builder, their capital stack understands the for sale model. You throw rental in where I want all 100 houses started 12 a month kind of thing, blows everything out, especially on the debt side.
Yeah, it does. And, you would think, if you come into the world of financing blind, you would think that it would be easy to go from buying a strat of land all the way through to selling homes. But there's just always been that disconnect that you didn't have groups that did it from soup to nuts. And yeah, John and the team are exceptionally great at what they do, and specialists in that arena. They have, they literally list out, one of the more transparent groups in the space. You list out, these are the markets that we are interested in, 2 million to 20 million, go right down the line. They know what they like, what fits the box, and that crossover is in our appetite too. So yeah, spectacular group and a great relationship we're excited about.
And for those who don't do a lot of A&D kind of investing or viewing, $20 million for A&D as an equity slug or debt is that's a good sized community. That's not, I'm building my house down the street kind of size. We
see a lot in our underwriting process that a lot of times the experience of the, let's say, the owner operator has a tremendous difference in not only the performance of the asset, but also the loss experience on those folks as well. Because unless you've got Randall over there guiding you through every step of the way, that it takes some experience. There's a knowledge base that's required there to keep bad stuff from happening.
Yeah,
only on one area, John. I mean, I would recommend partnering with you or others on this call for all the areas that I.
Oh, absolutely, 100% agree. Yeah. But I was listening to Mike and Don talk about the valuations. We're getting into an area where we're seeing properties, the value, let's say the sale value of properties is now significantly more than what the reproduction cost of those properties are, or the cost to build, unless we're talking about a build to rent portfolio. You know, we'll see things in the Northeast that are, we're being asked to insure them at $300-400 a square foot. And then if you go over into Buffalo, then people want to insure for, you know, 45 or 50 bucks a square foot. If there was a way that we could get some information, that the typical appraisal usually doesn't have the actual reproduction cost in there. It's usually more of a for sale valuation. If there's any way we could get data on that in areas and so forth, we'd probably do a better job of you know, getting folks the right amount of coverage at the right price.
Yeah, there's always going to be variables. I think we have about 5 minutes left, and I want to thank everybody on the panel. It's been a great conversation so far, but I think in the last few minutes, you know, let's just go around the horn, so to speak, and you know, anything we didn't talk about that you think is important for a group of investors to think about, to know, to contemplate. Why don't we just throw it out, whether it's best practices, your favorite markets, you know, anything of asset management versus property management, which seems to confuse a lot of people. So
yeah, I'll take a stab at it, Mark. So, you know, Randall, we were chatting a little bit about primary, secondary, tertiary markets, right? And primary markets, you know, more so than anywhere else, have just been absolutely exploding and are incredibly highly priced. Some certainly a little rich. So as investors are moving into, or rather moving outside of those primary markets, you know, definitely opportunities to be had there, but be cautious, right? Don't just assume that because something is 30 or 40 minutes outside of a primary market, that it is inevitable in your investing time frame that that primary market effect is going to roll out to where you're investing. I look at a place where that has happened, Atlanta. I'm in Greenville, South Carolina, so 2.5 hours away from us. You know, Atlanta has been an example of, if you bought outside of Atlanta proper, you have been in a great position, right? You look at Fulton, Cobb, Gwinnett, DeKalb, all those areas that are kind of on the outside. You've had Microsoft come in, Salesforce, all things that, if you're paying attention to the market, doing a deep dive, you can find your opportunities, but you have to do, you know, you can't rest on just general house appreciation and hope the further you get out from the center of primary markets. So there's something top of mind.
You know, if I could add to that. So in some of these smaller markets, the tertiary markets, there haven't been a lot of new apartments built or built for rent in years. And so with a little bit of movement of people moving out of the core areas to these tertiary markets, all of a sudden these apartment communities are now 98 to 100% occupied. And my colleague, Leslie Deutsch, who runs our Florida area, she saw this early on in some of her markets, where in the last 90 days, apartment rents in some of these communities have gone up by $200 to $500 a month. Now, if you think about it, if you're 99% occupied, you might have one unit available, right? And so I think that some of these landlords are just throwing out a hope for rent. If somebody takes it, great. And so, you know, maybe Dalton, that's to your point, or maybe Mike can comment on it, but if there's one unit available and the rent's up $500, is that the market? I'm not sure. So that's one thing that we are definitely looking at carefully as we're doing our feasibility studies. We're looking at trends in some of these markets to see what's real, what can stick, what's the income of the households there, what can they afford. So definitely pay attention to those kind of quick changes in the market.
I think one thing that's interesting is that, you know, in new homes or purchases of homes for a single family buyer or something, you know, we've seen in hot markets where people bid over list price, and we're seeing that a lot. we're seeing that now in the rental market, where they're posting the rent at whatever that is, and people, because they've lost out on the last 5 places to rent, are bidding above the asking price. So again, it's supply and demand, and it's not a unique thing. I think it used to be before where you say, this is what I want for rent, and you'd get it. And you'd have, 5 applicants or 10 applicants, and you'd decide which one was the best. Now it's kind of like, bid on it. And I have a friend that just had to do that. And it was, because he had a family, he'd sold his house, he needed some place to live. And so he just came in and offered him a few $100s above the asking price so he could secure it, and paid 6 months in advance too.
Right.
Mike,
So
can I
as-
jump in there from a cautionary tale? not to delve into fair housing at all, but definitely there's a right way to do that, and there is absolutely a wrong way to do that, and especially in today's world. But I did want to just mention that to Dalton and Don's point, I absolutely agree that it's not just about the market that you're looking at or outside of the market. Like we're seeing, for example, pops in secondary and tertiary that are significant. And it feels like investors are more comfortable in doing cross-market type of or cross-territory type of deals. Even first timers are reaching out to our property managers in Tulsa, Oklahoma, and saying, can you help me find a property in Tulsa, which is one of our hotter markets? And so it's just been really interesting to see that change. Management's obviously a big part of that. Don't leave that out. Don't forget about it. It's not the guy in the wife beater anymore. This is a true person who's looking at your asset, should be helping to make decisions about the buy, the management, doing what Mike's saying, getting the best price, the highest price, and good management makes for a good long-term asset. Your tenant should be in there and be happy for a long time to come. But
I think to piggytail off that as well is, for build for rent specifically, is having property management that knows build for rent. And so that you are specialized in that asset class, because it's so important and it's so different from scattered lot SFR, right? So knowing how to push rents and how far you can push rents. We see that as a huge kind of talk of the town right now, is what kind of premiums can you apply to these fully contained build for rent communities compared to scattered lot SFR. So, whether it's talking to investors or builders that we're consulting with, one of the, strong reasonings that we need to make clear is that those are different asset classes, there are different asset types, and that there's premiums to be had, and you're not going to necessarily have a build for rent community down the street to be able to use as a comp for those fully contained communities. So it's important to be able to make those, extrapolate from there. And to Don's point, look at trends and look at, rent growth and see where you can project those out. There's times where we're always, leaning on the conservative side of our underwriting, but there's some times where rents, will be proven out in a build for rent community 20 to 30% over what we could, really comp out truly with comps in the market. So I think once we start to move into these, further out tertiary markets, is just because there's a lack of comps doesn't necessarily mean that the project doesn't make sense.
Hey, Mark, I think you put together an awesome group today, and we covered a bunch of really cool things. I think that everybody's demonstrated with their knowledge that they're not just hawking product at you, and that I think that if an investor can use everybody on the panel as a trusted advisor, they're really going to be able to assemble a winning team. And hopefully that's what we've been able to project today, that if we can be in the trusted advisor role, we'd be more than happy to help.
Yeah, and John, thank you for that. And I completely agree. Can't stress enough the importance of a team. Don't assume, unless you have a huge company, that you can do it all yourself. There's a ton of variables, and everyone on the call, this is all I do. Insurance is all John does, and so forth down the line. So I want to thank all the attendees, all the viewers for joining today. And I definitely want to thank all the panelists for their time and their expertise. And feel free to reach out to any of us, and we can, if you only have SBN's email address, reach out to us and we can put you in touch with everyone on the panel. So with that, I think we're definitely just over our time. So I'll say thank you and wish everyone a good day.
Thank you all.
Thanks.
All right, bye.
All right, thank you.